Welcome, everyone. It is Fridays in Fintech, and we have an amazing guest today, Armen Meyer. Armen Meyer? Did I say it right?
You nailed it. Yeah, no Armando,
Awesome.
no Armand, Armin. Well done.
Well, a little bit about our guest, Armen. Super impressive background. I got to if I do say so myself. Started his career at doing. Whoops, one second. Started Armen's career started as assistant counselor for the New Jersey governor. Then went to become a campaign manager for U.S. congressional campaign. From there, worked for the state of New York at their executive chamber, and then became chief of staff at the New York State Department of Financial Services. From there, went to PwC, where he's a managing director of financial services advisory, and became a board member of a lot of really cool companies. And so your next major role was being LendingClub CEO of LendingClub PAC. Super cool stuff. And you ran, while you were there, ran public policy, regulatory affairs. And now I'd say you're advisors to a couple cool companies. You're also a venture partner at Rado Partners. I know some other guys there. And you're also a senior advisor of the American Fintech Council. Armen, it's great to have you here.
Thanks for that. Appreciate it. Great to be here.
Yeah, so we really ask the tough questions on Fridays in FinTech. So, do you prefer pineapple on your pizza?
That's disgusting. Absolutely not.
Super
Pineapple
hard
doesn't
no.
belong on pizza. Anything green does not belong on pizza. I love those things, but not on pizza, please. Is that it? Are we done? We got this over with?
That was a very probably one of our hardest. No. We've had some hard no's, but that was a pretty hard one. I mean, Armin, your background's super fascinating. What inspired you? I saw you went to work with the government, and I'm curious what led you down that path in regards to working with, the New York State Department, some of those things in your experience there.
Well, when I graduated law school, I wasn't sure if I wanted to be a lawyer or not.
Yeah.
You left out I did do a pure legal job for 1 year.
Yes.
With a
Yes.
federal judge in New Jersey in what's called federal district court, and that taught me, God, I like this, but I don't like it enough to make a career out of it. So I remained on that path where I had been working as a policy advisor, doing some law, but more policy and political strategy for the governor of New Jersey. What got me on that road? I think a genuine desire to make the world a better place. In my not so humble then opinion and slightly more humble opinion today about my ability to do that. Sure, things don't always go the way you want them to in politics. I worked for a couple folks who resigned for personal reasons, including Jim McGreevey, the governor of Jersey, who you mentioned.
Mm,
But then things worked out pretty badly for the world economy for me.
mm,
For the world economy, but well for me, because I was an advisor in economic policy
mm.
about 7, 8 years into my career when the global financial crisis hit. So we're talking 2008, 9. And the need to dig in if you had a policy mindset, if you had a communications and political strategy mindset, given our regulators were all under fire. New York's regulator was probably the most important state regulator at the time. New York had a vested interest in the outcome of how we supported banks and consumers and the homeowners who were being foreclosed upon, because a lot of that was in New York. And New York had a vested interest in the outcome of how we re-regulate the world, both by statute, this thing called the Dodd-Frank Act, which has paved the way to where we are today in a variety of ways. Almost most things we talk about today stem back to the Dodd-Frank Act, but also all the rules and regulations that came out of it, including implementation of the Basel framework out of Switzerland, which is still here about today because it's not done yet. There's all these
What
capital
what is
requirements.
the Basel
Yeah,
framework? What is
so
it?
it's this global framework that has been going on for decades, but was redone after the global financial crisis. And the global framework essentially addresses how much capital, how many safe assets banks must hold on their balance sheets when they lend or engage in operational risky activities or various other activities. And we still don't have global consensus on that. However, that was a huge part. A lot of that is now baked in the cake and was a huge part of the post financial crisis work, in addition to passing the Dodd-Frank Act and its regulations that attach to that act. So that's still going on. It started, Dodd-Frank passed 2010. Pretty
What
great.
was
Yeah.
I was curious. So you were part of the New York State Department, 2008, 2009, 2010. What was that like? What was and kind of were you involved in that, or what was your
Yeah,
experience
no,
with that?
I was very fortunate that a few things happened. One, New York was a resource of information for the Treasury Department, for the Department of Housing. Spoke to Secretary Geithner on a few occasions. Spoke to some of the key folks in the Housing Department on a few occasions to provide our input to how you re-regulate the system. Also to provide the data we were seeing on the ground and the ways the states could be helpful in the post Dodd-Frank framework. But in addition, the superintendent of the state of New York, who I began working for as senior advisor, people have heard of the Department of Financial Services. It was then called the New York Banking Department, and I became senior advisor and then chief of staff at that agency before we changed names to the Department of Financial Services. And during that period of time, we were selected to represent the states on this thing called the Congressional Oversight Panel. That was Congress's oversight over, you'll remember, the TARP bailout money, the 700 billion that the taxpayers footed to inject into banks so they wouldn't fail, which was paid back but was very controversial at the time. So very involved in the oversight of that, working with this person you've never heard of named Elizabeth Warren, who is then a Harvard professor, who I had come across, who I had met when I was in law school as a student. But she then, of course, became chair of that panel, led the media charge, had a lot of insights that were helpful, and then, of course, became a senator. So that was an interesting time because we needed to figure out how to keep the banks afloat, needed to figure out how to re-regulate going forward, and need to figure out how to help consumers, especially mortgage owners, who were in a lot of trouble. And I think what we did in New York led the way in some respects, where we identified problems earlier than the federal government, in part because states, and we'll get to this hopefully later, in this post-election world, states tend to step up in times of deregulation at the federal level. This was the George W. Bush administration. So the states were regulating in ways that the federal government was not. We got very active in how you regulate the mortgage market so that something like that doesn't happen again. As people will recall, the mortgage market was a major source of problems that blew up into the whole entire economy and caused a financial crisis.
Wow, that is so cool to hear. I just kind of seeing how being involved with that. I mean, you really helped write the future of financial regulation and how it works, and that's super cool.
I was only
Awesome.
influenced on a few sections. Most have nothing to do with me. But
No,
the
that's
things that
that.
involve the states, I was most active in. The things that involve, do states have the opportunity to protect their consumers when the federal government chooses to create a blanket law? Where does state law fit in there? It's the sections that involve that framework and tension I was pretty active in.
That's amazing. I was gonna joke. Did you hang out with anyone from The Big Short, that movie? Or maybe. Just kidding.
No, no, not nowhere near cool enough for that. I did
That's
see,
funny.
but to be honest, several of those people did engage with our department a little bit later,
Really?
actually, as I'm remembering it. The folks in that movie, and I don't want to name names, who kind of come off as the ones that caused the crisis and did some bad things. I saw shopping around their solutions for preventing the next crisis in startups, especially in a new mortgage framework. And they brought them to us, and we evaluated a couple of those on my way out in 2010. So that was pretty interesting, actually. So I guess the answer is yes. I did meet some of those people, but
That's
not
that's
not the
that's
heroes of the story.
yeah. They definitely were. That's super cool. Well, that's a fascinating experience. That's super fascinating. I wish we could dive in more, but I want to hear more about your amazing journey. From there, I saw you went to PwC. Kind of what, and then even a LendingClub. Kind of what was that journey like, and what made you want to make that leap into working with PwC and then eventually LendingClub?
A lot of people who work in government, as I had done, in kind of generalist positions, when they want to go to the private sector, tend to have to be a lobbyist or in political communications of some sort, or corporate communications.
Hmm.
I was pretty lucky that, again, like the world's catastrophe ended up being a small benefit to me personally, which I will always feel guilty about. It gave me the opportunity to become a quasi-expert at that time, and I think more of an expert today, on the financial regulations of the day that would impact the largest banks first, And then we'd start feeling more impact to the smaller ones. And then this thing called fintech that wasn't even a word back then. So at PwC, a lot of my work was, you know, some banks choose to hire lawyers to get around laws, and others decide, hey, you can't be queued. We're supervised entities. Let's create a lasting regime. And I had the opportunity to work with those banks and create the structures that would manage risk, whether it was capital, operations, how you deal customer complaints at several large institutions at PwC. As time went on, and some of the implementation was getting baked in the got to move towards the fintech aspect of banks, where banks were seeing these new technologies. These companies called Betterment and Wealthfront and LendingClub and Prosper, and the early fintechs, the small early fintech players that were emerging were scaring banks. So they needed to kind of do their own. So I worked with some banks at that time, creating their own competitive products, until I decided, hey, why don't I join? I'm on this side of the aisle. Let me go to the fintech.
Let me see. Let me see what it's like over there. It's funny. I remember I was at SoFi back in the day, and all their ads targeted at banks and stuff. And the mid-teens was just is a different era. It was crazy. Now it's like fintechs. Almost every fintech is now selling their software to banks, or at least like some way to integrate, be a partner. It's just funny how that's flipped.
Yeah, the motto at LendingClub was like creating a new system, basically competitive with banks. And I remember we were thinking we probably need to change that to the new reality, which is it's really about it's going to be about partnering. Let's be honest, we're not changing the entire financial system. We are just greatly improving it.
Yeah, yeah. It's more like a plug-in or an add-on to the system, or changing specific things about it to make it more efficient, better user experience. And you played a pivotal role, right, in acquiring a bank at LendingClub?
Yeah, no, LendingClub. I went there during the first Trump administration. So this guy called Donald Trump just became president, and the world of bank regulation had changed significantly. And I was pretty interested in seizing the opportunities that could come out of the change administration that would continue to do some of the good we did. And I saw fintech as a really great way of continuing to do some great work to help consumers. So LendingClub was a very obvious choice, and I was grateful that they took me on for essentially two things. One, to help them figure out how to become a federally chartered entity for a variety of reasons we get into in terms of regulatory stability and ability to kind of control your own fate with regulators rather than be at the whim of your bank that controls the regulatory relationship and at the whim of the 50 states that have their own opinions on how you should regulate it. So that was one aspect of my job there. And the other aspect of my job there was, how do we engage and kind of rewrite the rules if we don't become a bank? What should the rules look like for fintechs? And so not only did I think, bring a lot to help LendingClub tell its story, but really help change some rules in various states and at the federal level that impact non-banks, but also got to work with a lot of great people in the industry where we worked together and found we were stronger, and created eventually the American Fintech Council, which I co-founded and now went on the board of, and now I'm an advisor to. And that Fintech Council, I think, has done a great job bringing various types of fintech together to convey how regulation should work at the federal and state level in order to create stability that allows the economy to thrive and consumers to be served.
That's fascinating. So it kind of went from a little bit about your journey. You're part of the New York State Department, going there to PwC, helping the banks, then going to the fintech side, and now it's like, wait, let's now circle it all back, create this entity. I'd love to hear more about the American Fintech Council, like what your mission is, kind of what you're seeing now. But really now with the AFC, American Fintech Council, is you're bringing together both fintechs and banks and building this ecosystem of handling regulations as well as where innovation is going, and then helping them work together, right?
Well, it's really an offshoot of what you said, that we're no longer seeing this like dichotomization between non-bank fintech and bank. And the AFC actually reflects that. And it's actually hilarious because it reflects it so much that when it was born, it was a merger of the Marketplace Lending Association, an association primarily of non-bank fintech lenders, and of the Online Lending Policy Institute, which major benefactor was this bank called Cross River Bank. And then we brought in various other kinds of fintechs as well, both in the banking and non-banking side. But if one fact will show you the merger of banks and non-banks, it might be the literal merger of those two trades into the American Fintech Council, in addition to the literal merger of LendingClub buying a bank and representing the trend from non-banks either becoming banks or more and more partnerships. Now, the Trump administration ended up being a great opportunity for fintechs to become banks, but the window was not open long and only a few got through the window. The last 4 years, have we seen the other? We've seen not dichotomization, we've just seen partnerships rather than, if you will, mergers. But AFC has been a large part of helping partnerships flourish. During the past few years, of course, there has been blowback by regulators because I think, as is usually a trend, people see this great opportunity to make a difference as a bank, make some money, and not everyone does it right. And we did see some banks not do it well. We did see some fintechs not do it well. And I think we have to grow up as an industry and continue to grow up and make sure that we don't get ahead of our skis on regulatory compliance and customer service. And I think we're getting there, actually. And I think what we'll see in the Trump administration is that a lot of the work that happened in the past couple of years really bears fruit. We'll also see some relaxing of regulation, but that won't be the reason why it bears fruit. I think it'll be because people take it seriously and know you got to be built for purpose through administrations, not just administration by administration. And that's a lesson I learned post Dodd-Frank Act at PwC. And that's a lesson that we learned when we started the American Fintech Council, seeing the Biden administration come in. And it's a lesson at the American Fintech Council we continue to preach and execute on, which is we have to be built for purpose, not built for one administration.
Interesting. And kind of to your last point too, I think, right, you saw this innovation happening, Trump, maybe the 2016 Trump administration, hey, this new opportunity, embrace it. Then 2020 came around. It's like, also fintechs and banks, there's some that weren't doing it correctly or doing it completely right, but you almost needed that to help kind of set more frameworks as well as build the right systems or even software. There's new software players coming up to kind of help with that. So this next one will be super interesting. So I'm curious, what do you see happening or changing in the next 4 years, and really the development of fintech bank relationships, or even like more people trying to acquire banks, or even new types of regulatory frameworks?
Yeah, I mean, on the content we've been so to answer your question head on, and I think that we're only scratching the surface. There's a couple other great things that could come out of the next 4 years. But to start, we're going to see, in a way, a rerun, but a good sequel, I hope, to 2017, where charters are going to become the name of the game again for a bit. The people who are in the non-bank world who have been saying, I don't want that charter anyway, I think it'll be revealed that's really more of a fox in the grape situation where the grapes got too high and they pretended they didn't want it. The grape's going to come down. It's going to be possible to get a charter again in this administration. And that is a top of the house prerogative in many respects. And not everything is a top of the house prerogative, but I think that will be, both in the form of one, new charters that don't exist today. We'll see come back to life some of these charters that are not traditional depository taking charters, and we'll see fintechs want to get them. We saw that in the last couple of years of the Trump administration. They weren't very successful, all of them, but some were. Some began to show they could be successful at least. But we'll also see actual full-blown real charters. I think SoFi and LendingClub, the two that did it, that bought a bank, started as non-bank lenders and bought banks, showed the power of this. I mean, the LendingClub was never in danger during the Silicon Valley Bank situation, during the COVID situation of trouble in the way, and most importantly, how could I forget, rising interest rates, which is related to Silicon Valley Bank, of course. But you did see how a lot of non-banks lost their funding sources because they couldn't get funding for their loans at a low enough rate to make the loan work out and make sense to the borrower because of rising interest rates. That is not an issue at banks. At banks, you have lower cost deposits. Sure, you don't want to rip off your depositors, but it's still way lower cost than some non-bank credit facility out there. So you saw how the power of the bank model kept loans going during the past few years. So we're going to see, I think, more openness to full-blown charters and not floodgates open, but not just the drip drip we saw. I think there's going to be a lot more action there. That's just one thing. I think more broadly, though, we're going to see an embrace of technology in a way that even the Republicans were skeptical of last administration. I mean, I do remember being in meetings with senior government officials of the agencies, and some were still skeptical of this idea of fintech coming in and being a big part, whether as a bank or a partner to a bank. I think once we get through the consent orders of the FDIC, we're going to be on the other side of that, and we're going to see, wow, maybe there is a lot of good technology here that can not just reduce the cost of credit, not just expand access to credit, but a whole host of services, all the way to something, Jake, you know more than anyone about potentially, which is how can technology help us be better at compliance and at regulators? How can regulators use technology to be better at oversight? So whether it's fair lending, whether it's complaints management, whether it's checking out your marketing materials for potential violations of law in your communication to customers, we can go on for a long time, third-party vendor management, etc. There are just so many cool new technology use cases out there. Depending on the buzzword you want to pick, we can say Gen I and AI and tech. Those are all true depending on what we're talking about. But we need to teach new administration a lot of these great use cases, not just because it's efficient, but also because it's going to be better for the customer ultimately, because if we manage tech right, human plus tech does better than human alone. So we have to do this better for customers. And I'll say one more point. We will see more consolidation of banks over this next 4-year period. That's good or bad depending on your perspective. I think it's a nuanced position. I think people take blunt instrument views to whether or not it's good or bad. But I would like to say the following. Let the market figure out which banks should survive or not. And if the market can lower the cost of compliance for smaller entities, then those smaller entities have a fighting shot at proving the value they're adding to their local community, their niche in the national market, whatever it may be. But it's not a fair fight today where smaller institutions, the fixed cost of compliance just keeps getting higher and higher and higher. Too big of a portion of their revenue, not a fair fight. We don't want to see consolidation that's forced. We want to see it because innovators won and lack of innovation lost. And so I do think that RegTech, which we're going to see get more embraced over the next 4 years, is a big part of a better banking system overall, not just for the obvious reason of efficiency.
Yeah, it's super fascinating, and man, that's all really good sound bites. I even want to re-listen to this podcast myself. But yeah, it's kind of funny, right? There's kind of back to the point of these fintechs being more partners, and then these software vendors, like even like ourselves, right? It's like you come in, hey, we can offer you something where it can provide, JP Morgan or whoever big bank has, or Capital One has all these amazing engineers building all these in-house AI models and workflows, but now with LLMs, how easy it is to build, these banks have access to this. The other point is really compliance as a cost center, but maybe compliance and leaning a little bit into how do you really move faster, how do you prevent things, and how do you even learn from some of your compliant actions as well. And that's kind of, I think, what I'm seeing and what we're seeing, and maybe what will happen more is like, hey, we have this compliance tool, but essentially, if we take care of these things, we're seeing these other maybe revenue generating opportunities, not only a cost reduction thing. Which, yeah, it's kind of fascinating. What are your thoughts?
Well, yeah. To even press that point, most of the tech that you're more familiar with than me out there that would say manage your customer complaints can be used to go beyond the regulatory requirement of understanding, categorizing, responding to complaints to dividing your complaints in more refined categories so you get more insights in your customers, to looking beyond your formal complaints to the internet and social media and the blog posts and getting a sense of your brand that's out there and having more control of your brand, to seeing is there a pattern on your vendors, going back to the we need tech to bring the bank partnerships better, to bring RegTech bank partnerships better, you can now have much better insight into who of your vendors is doing well or not well based on what others are saying about them in a more tech-savvy way, analyzing all the information that's out there. We can keep going, but I'll do one more only because in a new Trump world, it's going to really matter more than ever before, to looking at how you communicate back across the internet, across your marketing, and are you subject to this thing called UDAP, unfair, deceptive acts and practices, abusive is added if you're talking about CFPB. But why is that so important? When the CFPB steps back, as any pontificator like me will tell you they will do a bit, if not a lot, in a few months. The states rise up. I mean, when I was chief of staff at New York, that was a real thing. Today, being in conversations with state regulators and consumer groups, it's a real thing today as well. The conversations are happening right now across the country as to how the states are going to pick up the mantle that the CFPB will not be as aggressive on in the future. And guess what? Their number one tool is going to be their enforcement authority. So tech can hopefully help institutions not accidentally fall in to that now ever more watchful eye, and let the people who are making their mistakes intentionally face scrutiny. Those of us who accidentally screw up, and there's a lot of that, there's this term called operational risk for a reason. Hopefully those do not draw the ire of the state regulators, who will be stepping up significantly over the next year.
It's interesting too, and to one of your other points too, like regulators will now have access to more technologies and stuff. It kind of made you think of the most recent rule, the open banking rule. I'm curious to hear kind of your thoughts on what does that mean for fintechs, banks, and regulators alike, and what does that future look like?
I am really glad you brought that up, because I feel like, in a way, open banking is the cousin of AI and the tech we're talking about to help make smaller banks more competitive. So I do think a lot of banks view open bank. What is open banking, just for the audience? It's the idea that, let's just use a huge bank as an example. The data that a huge bank, say JPM, has about its customers is actually the ownership of the customer, and in some ways a public good if the customer wants it to be. And by public good, I mean the customer can use that data to get a loan somewhere else, to take it for themselves and bring it to another bank for a better deposit product, another bank. And their data is not just stuck at that one bank. JPM is my example, just because JPM runs the software. It's the customer's data. Why is that good for the world and good for potentially smaller entities, including banks? One, because we'll see a world where price competition matters even more and better product wins if I'm a consumer and I can use my data to get a lower interest loan more effectively using open banking. Or if I can I don't lose my data if I dare to go to a bank that has a higher annual percent yield on their deposits. So they're working a more wealthy world for everybody, and that's why it's good for the world. It's also good for the customer, obviously, for a variety of reasons, assuming they want to give that data up. So that's what open banking is. Why it's going to be good for smaller banks, and I see it as a cousin of AI, because, I mean, how good is AI without data underneath it? It's horrible. So you need data for technology to do anything. And this is the cousin of that. Without data to analyze how good is your tech, it's not worth a whole lot. So if the data, though, is stuck and trapped at the 6th largest banks in the United States, then only those players can innovate. And we need to see a world where that data is not trapped. So smaller banks, just like what I said on, we don't want technology to be the reason, high compliance costs to be the reason why small banks fail. We don't want lack of data to be the reason why small banks fail. I want to see real competition. I don't want to see more banks take more banks, or fewer banks for the sake of fewer banks. I just want to see the good banks win. But I want the semblance of a fair fight that we don't even have close to right now. And data is a part of that fair fight. Lower compliance burden is a part of that fair fight. So that's the world I think we might hopefully see emerge in the next 4 years. But the open banking rule itself is in some jeopardy. It's under suit right now. I do hope it survives. I do hope the Trump administration defends the rule in court and sees it as not some burdensome regulation on the customer, or on small or on banks, but sees it for what it is, which is a regulation we should all be behind in creating a highway, creating an energy pipeline, creating a grid of communications. And those are the kind of things the government does best. And I think Republicans and Democrats can agree on that usually.
Well, it almost to throw in another buzzword, it almost reminds me of blockchain, right? Where it's like, hey, you now imagine all the tech that could be built on open data. It's like, hey, input your open data, or I don't even know what this would look like, but in here, all right, we're going to analyze your situation, and now we can actually see data from all other institutions. Here are some recommendations. Here's what we thought about, and here's what we found, all done automatically for you. And so it's almost like there'll be a new ecosystem built on all this data, and that's going to be super exciting. But Armen, I wish we could go on. This is so fascinating. Love the story. Always great chatting with you. But something we like at Fridays in FinTech, we believe in closed loop systems. So no KYC required, and for our guests, and what that means is we like to give out gift cards to random Midwestern chain restaurants. So for your gift on being on this podcast, we'll spin the wheel, and then we'll award you a random gift card.
A random gift card to a Midwest chain restaurant. Is that what you're saying?
Midwestern chain restaurant could be,
Well, I have
we
so
a
much
couple
family in Midwest, and if I'm lucky, it'll land on Applebee's because they love Applebee's.
Let's see. All right, I'm spinning the wheel. And today, ooh, a close one, but it's Chili's. So hopefully
Yeah.
there might be a Chili's that could be. I love Applebee's too. They have a great deal on their beers. But today you want a gift card to Chili's. So.
Can't fight that. I was a frequent visitor in law school, so it sounds great. Thank you. Great. Looking forward to it. Hopefully, I can. I'm sure it's going to be a huge gift card. I'll take you and your entire team out.
Yeah. Awesome, Armen. We're really great having you. Yeah, have a great weekend and really enjoyed it.
Well, thanks for having me.